Hey guys, it's Jamin Cook with Secure Financial Management. I just want to get out a quick video to you about what's been happening recently in the markets. There's been some exciting times, some new highs made in the Dow and the S&P and the Nasdaq over the last several weeks. A much happier time investment-wise than we had in May when we were dealing with some difficult economic news. And often the question we get from clients is, May to now, what's the difference, right? Now, the first thing I'm about to tell you, you've probably heard talked about in the news if you follow any of the financial channels as well, interest rates, right? They're talking about interest rates. The markets are expecting an interest rate cut soon, right? Don't know when it's going to happen, but they're expecting it soon. So that's the big story. Interest rates will be cut. But then it's like, what's the big deal? Why are the markets so dependent on interest rates, and how does it affect them for the negative or the positive, and why? There's really two answers to it. Okay, the first one, it's kind of a macroeconomic element to it, which I'll talk about in a minute, and then there's an investment component to it as well, as far as allocation and how that may skew more favorably to what we call equity investments. Let's talk about the economic element of it to start with. Okay, interest rates affect many components of the economy. Think at a very simple level. Buying a house, right? If interest rates are lower, it's easier to qualify to buy a house. It makes the payment lower, so it's more manageable. It either makes it easier to buy a house or buy a more expensive house, right? Vehicles. Some people pay cash, some of us are lucky enough to pay cash. Most people have to borrow money to buy a vehicle. It makes vehicle payments and therefore vehicle purchases more possible, easier to qualify for, or more expensive vehicles, easier to pay for and qualify for. So you can see with two major purchases that consumers might look at, it facilitates and makes easier those transactions, which in general are positive for the economy, more cash flowing through the system. So there's the economic element of it like that, a macroeconomic element of it like that. The other side to it is the investment allocation portion of it, right? Whether we're looking, most allocations break down into some percentage of equities and we say equities, we mean like stocks, right? Anything invested in the stock market. And a bond allocation. Typically that's the sort of allocation, a 60-40, 70-30. You've probably heard things like that in the past, right? What sort of allocation are we going to have? What are we going to put towards bonds? What are we going to put towards equities, stocks, things like that? Well, the lower the interest rates, certain elements like bonds will be affected in the fact that the return on those investments or those assets are going to be lower. It's going to affect things like bonds. The payment for bonds are going to be lower. The interest rate you can get on CDs, it's going to be lower. The interest rate you get in a savings account, as low as it already is, could go lower if interest rates are reduced. That's going to flow through to those asset allocations. So when money managers or individuals are looking at those investments, it's like, well, man, I'm getting even less than I was in my CDs. I'm getting even less than I was on those bond returns. Equities are starting to look a little bit better. There's more potential, there's more return, and you will often see funds flow into the equity portion for an allocation reason. And also, if there's more money flowing through the economy, those businesses that are listed on the stock exchange that you might invest in, the hope is that they're doing better as well, right? Because the consumer's out there spending in a low interest rate environment. There's obviously more complicated factors that go into interest rates, and it gets very detailed, but I just want to touch with you guys on some of the high levels of why interest rates matter so much and why we pay attention to them and why they can drive the stock market crazy in both directions, right? Both up and down. What are we looking for going forward? I don't know what the market's going to do tomorrow, next week, or next month, but I can tell you what we're looking at, right? Right now, we're in earnings season. Publicly traded companies have to report earnings every 90 days, and right now, we're in the midst of earnings season. It's going on this week. Next week is going to be the big earnings, the big week for earnings reports for the second quarter. Everyone's very interested in this to see what happened with the economy in the second quarter. How do businesses do? Were consumers coming in spending money still? Were sales up? Were they down? Were they flat? Was there growth? Was there contraction? What's happening? People are money managers are very interested to know what happened in that second quarter. We're going to be watching that carefully next week. If you see the markets move around a lot next week, I can almost guarantee you a big part of it will be because of earnings. If you want to watch along with us, we'd encourage you to. The more you know about what's going on economically and your investments, the better informed you are. Next week will be a big week for that. Guys, I just want to get that information out to you. It's been a little while since we've chatted, so I wanted to let you know what's been going on, what's been causing it, and what to look for going forward. As always, nothing that we talk about here should be taken as a recommendation. If you'd like to discuss your personal financial situation, please give us a call at the office, 210-428-6250. Thanks for watching.